Hello there. So today I want to talk about bank run. Okay, so first of all, what is a bank run? Well, a bank run occurs where depositors withdraw their money from a bank when they doubt that they will get their money back. Okay, so for you to understand how a bank run occurs, you need to understand the way banks operate. Okay, so most banks operate using a fractional reserve banking system. Okay. Well, so the fractional reserve banking system is under a topic in economics called money and banking. Okay, so let's explain what the fractional reserve banking means. So it's a system where it's a banking system where banks hold on to a fraction of deposits as reserves. Okay, so they do this using something called a required reserve ratio. Okay, so the reserve ratio is simply the fraction kept as reserve, the fraction of deposits kept as reserves. And we'll see how this whole system works. I wouldn't go into detail, but I'll touch on the important areas to help you understand what a bank run is. Okay, so to understand the way it works, we are going to look at the T account for a bank called the GH Bank. And so on the T account, you have what we call the assets and the liabilities. So the liabilities is what the bank is liable for. Okay, so it's in the form of the deposits, what people deposit in the bank. Okay, so let's say we have 100 people going to deposit in the GH Bank, and they deposit $1 each. So you have deposits of $100. Now let's say we are under the fractional reserve banking system, and you have a required reserve ratio of 10%. Okay, so under this system, it means the bank will hold $10 as reserves and loan out $90. Okay, and so that is how money supply is created. So let's see how this can result in a bank run. Okay, now this also leads to the concept of the money multiplier, which is simply the reciprocal of the reserve ratio, but I'll talk about that in a different video. Okay, so the GH Bank is running this fractional reserve banking system. Okay, fractional because it can be juxtaposed with another form of banking system called the 100% reserve banking, where all the deposits are kept in the reserves. Okay, but under the fractional reserve banking, since you keep a fraction in your reserves, you're able to make out loans and earn interest on the loans, which will help keep the bank running. Okay, so we have 100 depositors who deposited $1 each to the GH Bank. Now, the bank run can occur when, say, about 8 of them come to the bank and then they say they want their deposit back. Now, when they do this, because of the way the bank is run, right? The bank manager, okay, so let's say you have a bank manager. Okay, so the bank manager called Dixon might tell the depositors that there isn't enough money to give all of them. Okay, so you have about 8 people. Okay, so when this happens, these 8 people will tell their colleagues, their friends, or family that they try to withdraw their money from the GH Bank and they couldn't get the money. Okay, so we have a huge problem there. Okay, so it will cause panic. Okay, and when that causes panic, you see everyone scrambling to get their money back. Okay, and when they all try to do that, the bank will become insolvent. Okay, so insolvency simply means it becomes bankrupt. Okay, so when the bank fails to give back the depositors their money, we term that as a bank run. Okay, now there's some ways, there's a way some countries deal with this, and it's called the deposit insurance, and I'll discuss it in a different video. Okay, thank you.